is this affects crypto too. And if I look at the global money supply year on year against the year-on-year rate of change of Bitcoin, you can see it's a dominant driving factor of the overall direction. It is not the only factor, but a dominant driving factor. Now, global money supply has been shrinking because everybody's been tightening. So that has reduced the price of Bitcoin. So that was the crypto winter was essentially in that chart. The following chart shows that the money supply is cyclical too, and the ISM leads it by 9 months. And the ISM inverted suggests that the M2 rate of change is going to start rising again. So that basically tells us things like Bitcoin and risk assets, which ties into the NASDAQ being cheap and the exponential aid stocks being relatively cheap. There is a potential big turning point in markets to come. What I'm waiting for is that turn in bond yields.
Mm.
I think yields are forming a head and shoulders top with 265 in the 10 years, 275 in the 10 years as the neckline. If it breaks that, then we're going back below 2%. Inflation break-evens are already falling. So we've seen them fall sharply. And I'm expecting the oil market to show more liquidation. We saw a bit glimpse of that this week where we had some really rough days in oil. And I know there's a lot of oil bulls out there, and I understand the longer term picture. And Dwight Anderson made this clear in his interview is the thing that will pause the longer term picture is a demand destruction. And Warren talks about it as well. I think we are going to see more demand destruction in a shorter, sharper period of time. Then maybe oil steadies again back at $80 to $100 range, but the rate of change won't be as high. It won't keep going up at 100% increments, which means inflation is not as high. So the inflation we get out of this after this recession is going to be much less than people are expecting. People are over extrapolating past prices and rate of change than current prices. So that's basically my macro view, is maybe a bit more pain to take, really unclear. One gush lower, but the thing that will happen is that we need to brace ourselves for the economic impact. It's going to start to become clear to people, clearer than it is. People don't yet believe that story, but I think it's going to become very clear. Right, that's the key thing. Unemployment data is lagging. The ISM employment data has started looking at contraction. There's a lot of data that looks at forward-looking contraction of employment. You're seeing the tech layoffs day in, day out. So that's coming. It's not in the data yet because the data is lagged. CPI is a huge lag. The biggest lag of CPI is owner equivalent rents. So these things are all phased, which is why you tend to see after these inflationary bursts, I'm going to say something that might shock people, inflation goes negative. It went negative in 2009. It went negative in 1947. It can go negative just from the year-on-year effects, and after such big moves, the comps versus the previous year are really hard. So to end up with ongoing endless inflation is almost mathematically impossible. The question in people's minds are, can we get the 70s again where inflation came down and then it came back up again? Well, for that to happen, that was a demographic demand shock. We don't have that this time. Could we have another supply shock? Could China be a big problem? Yes. But we're going to have to move the oil price to 200, 300 to have the same magnitude of price increases with the year-on-year comps. That's a really tough call to say that that's the most likely outcome.